Steve Liesman joins us now with a look at why the Fed, you're calling the Fed a likely number two. That's not nice.
Well, when it comes to cutting rates, Joe, that seems to be the case. Remember, the Fed hiked rates earlier, lifted rates higher than the European Central Bank, but it looks now like the ECB is going to beat the Fed to the rate cuts, maybe as soon as June. Americans, you got to wait till the fall or who knows, even longer. So let's look at what happened. A couple of things economists tell me. Weaker European growth developing slack that's led to lower European inflation in the U.S. There was more U.S. government stimulus. They also have, though, better monetary policy transmission in Europe than in the U.S. Carl Weinberg from High Frequency Economics tells me the U.S. is growing briskly and Europe's economy is dead flat and not at full employment. They also have a credit crunch, and we don't. U.S. unemployment soared to nearly 15%. Remember that? But it's fallen sharply now. 3.9%, been below 4 for a long time. Peak in Europe at 8.6, but now it's at 6.5. A sign there's slack in the euro area economy that helps bring down inflation. We don't have that kind of slack over here. GDP, meanwhile, cratered by 15% in Europe at its worst, twice as bad as the U.S., but only came back anemically. U.S. growth has remained largely above trend. City economist Nathan Sheets tells me the U.S. exploded out of the pandemic. Lots of government stimulus, a quicker removal of restrictions, and a very eager American consumer. Europe was more cautious and, of course, hit harder by the Russia invasion of Ukraine. Sheets says the stronger demand in the U.S. is reflected in stronger growth, but also in higher inflation. European inflation has been relatively steady, just above the 2% target, trending down. The same measure in the U.S. been bouncing above 3% and not giving Fed officials confidence to that it's headed to the 2% target. One of the biggest differences here, ECB policy transmits better into their economy. Most of their lending comes from banks. The U.S. has a very large non-bank lending sector that gets around Fed policy in a lot of ways, making it tougher for the Fed. So that might mean, guys, we have to wait longer for tighter Fed policy to restrain inflation. And Joe, pick your model here. Do you like the more government spending, higher growth, maybe longer lingering inflation, or do you like the European model where their economy tanked, or maybe you got a better idea?